And what about tech stocks?
Tech stocks are the future, and I think that's one of the reasons why the equity market is justified at this level and why the economy is changing the way it is. And I'd point out that in the US market as a whole, the top 4 or 5 stocks are mostly technology. Facebook, Amazon, Google, those are the Microsoft, those are the really big stocks in the US market. That means there is a market here that can grow and can develop and can really drive a lot of the future of the world. If you look at other markets around the world, they're old economy stocks. Many fine companies in Europe, but their financials, their manufacturing stocks, HSBC, BP, those are the biggest stocks in the European market. That isn't really where the economy is going in future. So I think Europe, relative to the US, has been a value trap for the last 2 or 3 years and will continue to be so.
Great. And as far as deflation, you say that there's some technology is building in some deflation and that'll keep interest rates low.
I suspect that's right. It's one of the puzzles. Most economic commentators, if they'd been shown 4 or 5 years ago what the US economy has done, they'd have said, whoa, rates will be high, that the 10-year will be 4 or 5%, the short rates will be 3. They'd have said that rates had to go up because at the current sort of economy 20 years ago they would have. What they're missing is the fact that the prospective inflation is a lot less because of the rapid adoption of technology. And I think that means that the valuations remain okay on equities. Same's true of commercial real estate. 5% cap rate on commercial real estate. It's done very well, but it's still not overly extended given the likely outlook for interest rates.
So for 2018, you think that the economy can continue to expand and that US equities can continue to rise?
Well, here's what I would say, which I hope is a helpful comment. 80% probability, it continues pretty good. 80% probability you get 2 or 3% growth on the flawed GDP numbers that we've been talking about, that you see profits growth even after the acceleration caused by lower tax rates. So 80% probability things are all pretty benign. Inflation doesn't really hit. So you've got bond yields around the current level, maybe up a bit at the short end as the Fed tightens further. But you could see equities be a bit better. What's the other 20%?
What is it?
The other 20% is the negative tail risk, mostly from geopolitics. Something bad happening in Korea. Looks less likely at the moment, but military hostility is still possible. Something bad happening in the Gulf. There's a lot of change going on in Saudi Arabia. That we all hope goes well, but if it goes badly, it could interrupt oil supplies to a lot of the world. A trade war. It doesn't look at the moment as if we're going to pull out of NAFTA, but if we did, that would hurt supply chains on business. Any of those and a number of other things could cause the market to go down quite sharply and could bring the next bear market forward. But I don't think it's the most likely outturn. That's why I give it a 20% probability of one of those negative tail risks. I think that the real decline, absent policy errors in the market, is 2 or 3 years away. If you like, in terms of the 1998, 99 internet boom, we're still in early 98, we're not in late 99. If that's true, there's quite a long way to go on the markets.